All right, so we're going to take a look at receivables. So we know receivables is when we perform services or deliver goods to customers and they owe us money. But an unfortunate fact of business is that all of our customers are not going to pay us. So how do we handle accounts receivable when our customers don't pay us? So a couple methods we're going to look at. First is the direct write-off method. So the direct write-off method is exactly what it says it is. As an account is deemed collectible, so as we doubt that we're going to get paid, the person that owes us money leaves the country, we're going to write off that receivable. So the direct write-off method simply says that when an account is deemed uncollectible, we debit bad debt expense and we credit accounts receivable. So now the receivable that we're not going to get paid for is off the books, and then we recognize expense on our income statement for the write-off of the uncollectible receivable. The other method is called the allowance method. So the allowance method, we make an estimate. So we estimate uncollectibles, and the idea is that we're going to match the estimate of receivables uncollectible with the period in which the sales are made. So let's look at an example. So let's just say sales were $1 million. And we estimate $10% to be uncollectible. So 10% of 1 million is 100,000. So what we would do is we would debit bad debt expense for 100,000. And then we're going to credit allowance for uncollectibles for $100,000. So what we're doing is we're setting up a reserve. We're setting up like a piggy bank. So we have allowance for uncollectibles now. Where we have a balance of $100,000. So now, as accounts are deemed uncollectible, we're not going to debit bad debt expense. So as accounts are uncollectible, as accounts are deemed uncollectible, we're going to debit allowance for uncollectibles and credit accounts receivable. So what we did is we filled up this bucket with $100,000. And then as accounts become uncollectible, we just take it out of the bucket, take it out of this $100,000. So we hit $100,000 on our income statement all at the beginning when we made the estimate. And now, as we actually write the accounts off, we're going to take it out of this bucket. So that's called the allowance method. And when we took 10% of sales to be uncollectible, that's called the percentage of sales method to estimate the uncollectibles. All right, so please review and reach out with any questions.